My name is Melvin Teo, and I'm the Deputy Dean at the Business School for Faculty and Research. I'm also the Lee Kong Chian Professor of Finance. My research interests primarily lie in hedge funds. Hedge funds are alternative investment vehicles that are supposed to generate alpha both in up and down markets. Hedge funds are interesting to me because of the cross-sectional heterogeneity that they have. Because of the incentive fees that they charge, they tend to attract the best and the brightest. And because of the lighter regulation that they face, they also tend to attract the frauds. So what I do in my work is I investigate topics like alpha generation, information asymmetry, asset liability mismatches, and behavioral finance, all in the context of the hedge fund industry. And I started working on hedge funds roughly in 2004. The reason why I like hedge funds is because it's a relatively unexplored world back then, at least for research. So back in 2008, people were worried that hedge fund managers were taking on a lot of liquidity risk on their books. That means their assets are highly illiquid, but at the same time, they said that they could provide investors with lots of liquidity. Unfortunately, they couldn't, so they eventually had to prevent investors from redeeming from their funds. This is known as a gating, which affected lots of investors during the financial crisis. So we wanted to understand this whole asset liability mismatch issue a bit better, and we looked at liquid hedge funds that sort of provide monthly redemptions to their investors, so investors can redeem every month, which is fairly liquid in this neck of the woods. And we look at the benefits of them of taking on liquidity risk. So we find that those managers who took on lots of liquidity risk on their books were able to outperform significantly those managers who didn't. So there was a liquidity premium to be harvested on the asset side. Does this create a problem? Because it's very tempting to take on lots of liquidity risks and at the same time tell your investors that you are still fairly liquid. So we find that it actually does, because when investors pool money from the fund, there is a knock-on effect on a fund's performance. So fund flows in the last month sort of precede an underperformance in the next month. So this idea is that there might be a fire sale effect going on through fund flows for hedge funds. And this effect appears to be stronger when markets are more illiquid, it's stronger when hedge funds take on leverage, it's stronger when incentives are more misaligned. So it's very important when you invest in a hedge fund to not just understand the liquidity of the fund redemption terms, but also understand the liquidity of what they have on their books.